Okay. So our chapter here, building blocks of managerial accounting. Last week was sort of high level. We talked about accounting careers, the difference between managerial and financial accounting, as you might remember, right? But now we're getting into more of the nuts and bolts of how you actually do managerial accounting. So do you remember last week we talked about merchandising, manufacturing, and service? And those are the three basic business types that are out there. Now, the accounting differs a little bit between these three types of business, right? But they all use managerial accounting. What did we mean by merchandising? What does that mean?
Retail.
Retail? Yes, retail. We're going to talk about costs. A lot of this course has to do with tracking costs. Revenues are not that hard to track. Costs get kind of complicated. So we'll start working on some of those different concepts that are going to be helping us throughout the whole semester. Things like, as some of you said earlier, variable costs, fixed costs, and total costs. Really important concepts. And how to predict future costs. This is sort of a neat little mathematical trick that we'll get into. When you have a combination of fixed and variable costs, how can you then project future costs considering that you have both variable and fixed components, and you might not even know what those amounts are. So if you just know the total cost, how can you project how much of that is fixed, how much is variable, and use that to estimate what future costs are? There's a way to do that. Once you learn it, it's kind of neat. And so we're going to get into that this week. It's called the high-low method. We'll get to that later. All right. I don't think we really need to spend time on this slide, right? You know the difference between merchandising, manufacturing, and service. But what's important is it does impact the financial statements to some degree. For example, if you look at a service business's income statement, they don't have a cost of manufacturing because they're not manufacturing anything, right? They do have some expenses related to their services, but it's not like with a manufacturing firm where you have a cost of goods sold, which tells you your gross profit, right? So service companies' income statements are simpler in general. Even if you have a merchandising company where you're not manufacturing products, there's still a product cost because you're having to buy the finished goods that you can resell, right? So even merchandising companies do have a cost of the goods that they sell, which means there's also a gross profit that we can calculate, okay? So we see that service companies are a little bit simpler to account for. Between merchandising and manufacturing companies, which do you think are going to be more difficult to keep track of their costs? Merchandising or manufacturing? Which one? But between those two, which one would be harder?
Manufacturing.
Yes.
Manufacturing? Yeah, exactly, because they're exactly, you have to keep track of all those manufacturing costs, all the materials, all the labor, all the overhead. Okay? Whereas if you're just buying a finished product, that's it. That's just one cost, right? It's a lot easier to track. So a big part of this course is going to be learning how to track those manufacturing costs. And there are different methods. So this is where sometimes it gets a bit tricky. All right? We'll start to get into some of those concepts. So, okay, here we go. We have a retailer. We have the data here. And let's make an income statement for this retailer. You're familiar with income statements from financial accounting. What goes, other than the name of the company, income statement, and the date, what would be the next thing we would put on the income statement? The date, but under the date.
Oh.
Revenue, right? Revenue comes first. So what's the revenue? 150,000. This retailer has only one type of revenue. Sometimes companies have multiple categories of revenue, but in this case, there's just one. Everything else you see here is an expense. So they're all going to go under expenses with one exception. Which of these accounts would not be included with the rest of the expenses? Which say with them? Yes, that is it, cost of goods sold. So this is what the income statement would look like. We'd start with the revenue, take out the cost of goods sold, and that gives us the gross profit. Then we take out all the rest of the expenses to get to our net income or net loss. Why do you think we do it that way? Why separate out the cost of goods sold and gross profit?
What we made after having to pay for
Yeah, it helps us understand which of our expenses had to do with actually making our product, or for a retailer buying the products that we're going to sell, and then which of our costs had to do with other things. That's an important differentiation. Okay? Because if you didn't know that and it was just lumped in there with all the expenses, you wouldn't know where to focus if you're trying to reduce your costs. You wouldn't know, do we focus on the cost of the items we're purchasing or manufacturing, or do we focus on something else? So separating it out helps us understand where the costs are within the company, right? So in this case, in fact, it's split pretty evenly. They've got $60,000 cost of goods sold, and they have about $60,000 of operating expenses, almost, right? But we wouldn't know that. It wouldn't be easy to see that if we didn't break it out that way. Okay, so that's not too hard, right? All right, let's say we didn't know that this cost of goods sold was 60,000, right? Sometimes as accountants, we need to figure that out. So how would we come up with that? If we knew our beginning inventory, meaning we knew how much product we had available to sell at the beginning of the period, and we knew how much product we purchased during the period, and we also knew how much we had left over, in other words, how much product we hadn't sold, by the end of the period, we could then calculate our cost of goods sold. So let's see what that formula looks like here. Beginning inventory plus whatever we purchased during the period minus the ending inventory gives us our cost of goods sold. Okay. So that's how we would calculate cost of goods sold, which then goes on the income statement. Are there any questions about that? You're going to see this type of formula a lot this semester, where we start with something, it's usually beginning something, and then we add something to it, and then we subtract the ending, whatever it is, and then we get our total. So beginning plus something minus ending. Okay, it's going to be a very common formula. All right, and if we take that formula that we just saw, it tells us cost of goods sold. That, as I mentioned, goes here on the income statement, so we could figure out our net income. Okay, make sense so far? All right. Now, let's go a step further. Oh, this is actually a manufacturing company. Okay, as I mentioned, in this case, it's not just the cost of purchasing finished goods, now we have to figure out the manufacturing costs, which includes labor, materials, and overhead, right? So part of figuring out our cost of goods sold for the income statement, if we're a manufacturing firm, is this formula, the schedule of cost of goods sold. Notice it's a similar formula, just the words are a little different. We're starting with our beginning inventory. Now it says beginning finished goods inventory. What do you think finished goods means? Is that
Ready to sell.
Yeah, they're products that are ready to sell, right? Because in this case, we're a manufacturing company. And we might have some products we're still working on and they're not finished yet. And that's called work in process inventory. Once a product's done, it becomes finished goods inventory. So at the beginning of the period, how much finished goods did we have ready to be sold? Then, what was the cost of goods that we manufactured during this period? So what's the cost of all the new products that we made in this period? Minus, at the end of the period, how much finished goods did we still have that we haven't sold yet? Do you see how it's really the same formula, just slightly different wording? We have beginning plus what we manufactured minus ending, and that gives us cost of goods sold. All right, are there any questions so far? Okay, good. Well, we're not done yet because how do we get this cost of goods manufactured? Where does that come from? It's like one of those, in Russian, it's called matryoshka, but we call them nesting dolls, right? Where it's a doll, you take it apart and there's a smaller doll inside. You take that apart and there's a smaller one inside. That's kind of how this works. Okay, so before we get to the cost of materials, this just compares how we figure out the manufacturing costs versus the merchandising cost for the goods. What's the difference between these two rows here? Which wording?
Cost of goods.
Exactly. They both start off with beginning inventory. Here we have cost of goods manufactured. Here we have cost of goods purchased. And that's really the only difference. They both subtract ending inventory, and that gets them to the cost of goods sold. Okay? Okay. So here's where we see the cost of materials, right? Cost of goods manufactured. Yeah. So here, that comes from the schedule of materials. So notice we take our beginning materials inventory. So materials inventory is talking about raw materials. If we're a bakery, it would be like flour would be an example, right? That would be a raw material. So how much of that raw material did we have at the beginning of the period? How much did we purchase during the period? And then subtract how much was left over at the end of the period. And that tells us how much of that flour or material we used in the period. Okay, so we know then the cost of the materials that were used. That goes over here to help us figure out the cost of what we manufactured. Now this formula you see says work in process inventory. Remember I said that's the products that are not complete yet, right? The ones that we're still working on. So how much work in process inventory did we have at the beginning of the period, plus all of our manufacturing costs, which includes those materials that we just talked about, any labor costs related to production, any overhead related to manufacturing, all of that goes into our manufacturing costs. Then we subtract out our ending work in process inventory, which means products that we're not done with yet at the end of the period. And that gives us our cost of goods manufactured. So the direct materials schedule gives us this information. We add the labor and the overhead for manufacturing, and we can calculate cost of goods manufactured. All right, so, and I think this next slide ties it all together. You can see the whole nesting doll here, right? The direct materials goes here, gives us our cost of goods manufactured, goes over here, gives us our cost of goods sold, which goes on the income statement. A lot to keep track of, right? Every cost, every purchase, inventory as it moves from one department to another, the inventory in this job compared to the inventory in that job. That's the sort of stuff we're really going to be focusing on over the next several weeks. A lot of costing, keeping track of costs. Any questions so far? Somebody asked me a question. I know you have one. Jahira.
Aside from the right to the left?
In this case, yes, because this is the like sort of smallest, most detailed thing from the materials. The materials become part of the manufacturing cost, which becomes part of what we sold, which becomes part of our total income statement. Right. Yeah, so you would need this information on the right before you could do this, before you could do that, before you could make your income statement. It's nice when we're just given the numbers, right? But now it's like, well, where do these numbers come from? How do we figure out these numbers, right? So it gets a little more complex. All right, anything else?
The easiest part.
This is the easiest part of the chapter?
Yeah, the rest of it, they give a definition and then they're like, but if you want to do it like this way, then it can also be this cost. Thank you.
Yeah, reading the textbook's always
So difficult.
challenging, yeah. Okay, I mean, it's hard enough to grasp it when somebody's explaining it to you, right? Let alone in paragraph form, you're like, I don't get it, right? So don't feel bad if the textbook's not always sinking in. But hopefully between the lecture, the textbook, and doing the exercises and the problems, then things start to make sense. All right, so here we see an income statement. So we're gonna see, an example, right, of what I've been talking about. So here we see an income statement for a manufacturing company for one particular month. We see their sales, cost of goods sold. How do we get the gross profit? Subtract, okay, so sales or revenue minus cost of goods sold gives you your gross profit. Sometimes it's called gross profit margin, the same thing, or sometimes gross margin, just to kind of mix things up, but it's all the same thing. Then we take out operating expenses. So any other expenses related to operating that are not part of production. And then we get net income, or in this case, they called it operating income. Again, just trying to confuse you a little bit. So where did cost of goods sold come from? Well, here we go. Start with the beginning finished goods inventory plus the cost of whatever we made. That gives us goods available for sale, which makes sense, right? That's how much product we had available to sell, minus how much we didn't sell. The ending finished goods inventory is whatever didn't get sold. And that's how we got cost of goods sold. So what are we going to see on the next slide, do you predict? Yeah, how did we get that cost of goods manufactured? Right, so here's the schedule of cost of goods manufactured. And we start with our work in process inventory. How much of that unfinished product did we have at the beginning of the period? Add to it any new manufacturing costs for direct material, labor, and overhead. Each of those has to be calculated. That gives us our total work in process minus whatever's left over at the ending of the period, meaning any products that are not complete yet at the end of the period. Okay? That gets subtracted, and that tells us the cost of the goods we manufactured. Where did that material cost come from? Again, same formula, right? Beginning materials plus whatever we add to that, whatever was purchased, minus our ending materials. That gives us the cost of the materials we used in production. Okay? I know we've kind of seen the same phenomenon here 3 times in a row. I just wanted to make sure you get how they all relate to each other. Are there any questions? There's a bug up there. I just trying to figure out if it's a mosquito. It's not going to go well on the video. But... Oh, I got it. Sanitizer. Pass me some sanitizer. That's all right. Sorry. You guys have that. Okay. Any questions out there? Yes, Sharon.
Have like a physical like example of it, or the position of the product going through this process?
A product. Well,
Or like an example?
I mean, let me think. Okay, yeah. All right, we'll start here and we'll go the other way. So again, I'll just use bakery because it's the first thing that came to mind. So let's say this is flour, right? Because bakeries usually use flour. And so at the beginning of the period, they're saying, okay, this is how much flour we have. We have $500 worth of flour, right? And then that was, let's just say, the first day of the month. Okay, so it's the beginning of the period that they're measuring. And then maybe they bought some more flour during that period because they expected they would need some more. And then at the end of the period, they say, okay, how much flour do we have left over? And by doing that calculation, once they subtract out how much flour has not been used, they know how much they did use, right? And then that would go into here. So now let's say at the beginning of the period, they had, I don't know, $800 worth of donuts that weren't quite ready yet. And then during the period, they added that extra flour and any other materials that they used during the period. And they add their labor costs, and then they add their overhead, which would be like the electricity, the insurance, the rent, any overhead costs related to production. Okay. And then at the end of the period, how many baked goods do we have that aren't quite ready yet? What is the cost of those baked goods that are still in process? Subtract that out, and then you know what was the cost of everything you manufactured, right? Oh, okay. Visual. Oh, did I go the wrong way? Oh, yeah. Okay, so here we go. So then for this schedule, we'd be looking at how much finished baked goods did we have at the beginning of the period, right? How much new baked goods did we complete? Subtract out how many, or the cost of the baked goods that are left over. And that gives us our cost of goods sold. And then that goes on to the income statement. That makes sense? Right. I had to think about that. And am I going the wrong way? Let's see, where am I? Oh, no. Okay, so this is, that's as far as we got. Okay, any other questions? All right, a service company. Like I said, service companies in general are easier because you don't have all these manufacturing costs you have to deal with, right? So if we were going to make an income statement for this service company, which is a law firm, what would be, which of these costs or amounts, which of these amounts would go on top?
Service revenue.
Okay, the service revenue of 1,500,000 is correct, right? And then we would take out the expenses. So we see the revenue on top, all of their expenses together, totaled up, subtract that, you get your net income. So much easier, right? Ooh, an exercise. All right. So let's do an exercise. I'll pause the recording. Okay. Fixed versus variable costs. This is a concept that in one sense is simple and in another sense is tricky. Okay? I'll try to explain it in the clearest way I can. The difference between fixed and variable costs is that fixed costs stay the same regardless of how much you produce. Fixed costs stay the same. Let me amend that. Total fixed costs stay the same regardless of how much you produce. Okay? Compared to variable costs. Total variable costs change based on how much you produce. And that's why they're called variable, because the more you produce, the more your total variable costs will be. Okay? And the reason the word total is important is because it differentiates the total sum of the variable costs versus the variable cost for each unit. Okay? And that's going to be an important concept in this class. Total costs versus cost per unit. So which total cost stays the same regardless of production? Fixed. And which total cost varies based on how much you produce? Variable. Okay? Remember that. Because then when things get complicated, you can think back and that will help you remember the difference between the two. All right? And we'll get to the tricky part later. Want that simple part to sink in. So let's look at some examples. Fixed costs would be things like rent. Because if you're renting a factory or you're renting a piece of equipment, okay, sometimes maybe equipment's not the best example. Let's just say you're renting a factory. You're going to have to pay the same rent regardless of how much product you produce, right? So your total rent is going to stay the same. Same thing with insurance. When you have an insurance policy, and companies have all kinds of different insurance policies for liability and workers' compensation insurance, all kinds of different insurance. But for the most part, they're not tied to how much you produce. You're going to pay the same amount of insurance if you produce nothing or if you produce 1 million units of your product. Insurance pretty much going to stay the same. So it's a fixed cost. Salaries. If you've got some, let's say, plant supervisors or factory managers that get paid a salary, they get paid the same amount, again, whether the plant is producing nothing or producing 1 million units, their salary stays the same. Usually, okay? So those are fixed costs. And we can compare that to variable costs, things where the total variable cost changes based on production. So if you have hourly workers, the more you are producing your product, the more hours you're going to expect people to work, maybe even overtime. And that's going to increase your total wage costs, right? So wages are a variable cost. Salaries are fixed. Wages are variable because they're hourly. Okay. Electricity, obviously, the more you're using your machines and your air conditioning unit to produce your products and keep your factory cool, the more electricity costs you're going to have. The more materials you use, the more material costs, right? Any question on the difference between variable costs and fixed costs? Okay, yes, Mr. Howard.
You said variable changes based on how much it produces?
Yes, the total variable cost changes based on how much you produce, right? Okay, good. Here is an example. So this is a hotel. The hotel has fixed costs of $2,000 per month. So let's just take a look at this column and you see it's $2,000 a month. It doesn't matter if they rent out 0 rooms or they rent out 100 rooms, they still have those same fixed costs, whatever they are. Right? And that's what fixed means. They do not change based on production. Now, they have some variable costs of $5 per room. So those variable costs, the total variable costs, are going to increase the more rooms they rent out. So if they rent out 0 rooms, 0 times $5 is $0. So there's no cost. But if they rent out 60 rooms times $5 each, that's $300 of total variable costs, right? And 100 rooms at $5 would be $500 of cost. So we see the total variable costs increase the more we produce, or in this case, the more rooms we rent out. And then if you just add the fixed part to the variable part, we get our total cost. So we have our total fixed cost, our total variable cost, and then our total cost. Right? So the total cost includes the total variable and the total fixed. Any questions so far? So here we see the same thing visually. Those fixed costs of $2,000 stay the same regardless of how many rooms we rent out, right? So if it's 0 rooms, we have $2,000 of fixed costs. If it's 100 rooms, same $2,000 of fixed costs, right? The variable costs, remember, start at 0. If we rent out 0 rooms, we have no variable costs. That might be things like housekeeping costs, or that housekeeping is the only thing that comes to mind. I'm sure there are others. Reservation costs, maybe. So if we rent out 0 rooms, we have 0 variable costs, but it's $5 per room, right? So the more rooms we rent out, moving this way, the more cost there's going to be moving that way. So we see a diagonal line where the variable cost increases based on how much we produce. Then if we combine those 2 lines, fixed and variable, we can see our total cost line starts at $2,000. Just like we saw here, even if we rent out 0 rooms, we have $2,000 of costs. So it starts there, and then it goes up parallel to the variable cost, right? Because those variable costs are increasing the total cost. Makes sense, right? Pretty simple to understand. Good. Okay. Now let's say we took the total fixed cost, which in that case was $2,000, right? And we wanted to know if we rent out 10 rooms, what is our fixed cost per room? Well, we could take the fixed costs of $2,000, divide it by the 10 rooms that we rented out, and we would see that we have an average fixed cost of $200 per room. So you can do that. You can take your total fixed cost, divide it by the number of units, and you get a cost per unit. Here, they're calling it an average fixed cost. I prefer to call it a fixed cost per unit. Okay? And we could do the same thing. We could take our total variable costs, whatever they happen to be. For example, let's just go with 100 rooms. We know that our total variable cost is $500. So we could say $500 of variable costs divided by 100 rooms means our average variable cost, or our variable cost per unit, is what? $5. Right? Okay, so those are some simple formulas. They will come in handy sometimes. So you need to figure out, how do you get from a total fixed cost to a fixed cost per unit? Or how do you get from a total variable cost to a variable cost per unit? Just divide by the number of units. Right? Any questions? Okay. Now, here's a different scenario. This company is making t-shirts. We can see their fixed costs in this column. They have monthly rent that stays the same regardless of production. They have the number of t-shirts manufactured. We've got 3 examples: 200, 400, and 600. So if we were to use that formula that we just saw, we took our total fixed cost divided by the number of units, then we get a fixed cost per unit. Now, what do you notice about the fixed cost per unit as we increase in units? It's cheaper. It's getting cheaper. This is one of the reasons why big companies that make a lot of product are more profitable, because they're making in larger quantities and they're spreading their fixed costs across more and more units. That brings down their fixed cost per unit, increases their profit margin. Okay? So keep that in mind. The fixed cost per unit goes down as production goes up. Total fixed cost stays the same. Fixed cost per unit goes down as production goes up. All right, let's look at their variable costs. For this company, they use ink on their t-shirts, which cost them 15 cents per t-shirt. Now, we already know the total variable cost changes with production, right? The more we produce, the more units of product we produce, the more our total variable costs. But what happens with the variable cost per unit? It stays the same regardless of production. Okay? This is why it's really important to differentiate between total costs and cost per unit, because the way they behave is different. So keep in mind, with variable costs, the cost per unit stays the same regardless of how many units you produce. But when you multiply that variable cost per unit times the number of units you produce, that's where you get your total variable costs. And that's the part that increases the more you produce. Okay, so simple but tricky. What questions do you have? You look like you have a question, Alexander. Questions? No? It's all clear? Okay, we'll find out. We'll see if you really get it. We have an exercise. All right, so let's do that. Okay, we've talked about fixed costs and variable costs, right? Now, sometimes there are what are called mixed costs, which are a combination of fixed and variable. Yeah, so, so here's an example. Let's say we lease a copy machine. You've probably seen out in the hallway, big old copy machine printer thing sitting out there. And as far as I know, Hartnell does not own that. We lease it. And we probably pay a monthly fee, which is fixed, the same amount every month. And then we also probably pay a per unit fee. So the more pages we copy or print, more of that total variable cost we're going to have. Okay, so for that copy machine, it has a mixed cost, a fixed component and a variable. Sometimes electricity bills work that way. You have a basic cost for your electricity, but then if you go over a certain amount, they start charging you per kilowatt hour or something. So that would also be then a mixed cost.
Or use it after.
Or if you use it after a certain hour, yeah, maybe your rates change. So that's what a mixed cost is. There are 3 different methods you can use to estimate what future mixed costs will be based on your past mixed costs. We will look at these 3 examples. One way is to use what's called a scatter graph. And you can make these in a spreadsheet program. You're not going to have to actually do this. It would be good practice, but I decided not to require you to actually make graphs in this class. But if you feed the data into a spreadsheet, you could have this spreadsheet create this scatter graph. And then based on that, you can estimate what the mixed costs would be based on different levels of production. So that's one way you can estimate them. Another way is the high-low method. That is a manual process that we will learn to do. We don't have time to do it today. We will for sure do it on Thursday. And then there's what's called a linear regression. You could also do that in a spreadsheet. That's going to be the more accurate method because it calculates exactly what the relationship is between increasing production and increasing mixed costs. We're not going to do that in this class either. So we're primarily going to do the high-low method. Are there any tech wizards that can tell me why the computer makes me go all the way over there to see it works? But it's like the first time that I step away, it requires me to go back and click. I don't know why. So here's an example of what mixed costs could look like. If you think back to the example of the hotel, remember they had a $2,000 fixed part of their costs. And then they also had variable costs for house cleaning or reservations or whatever. And so if we add them together, we get the total costs. And we could look at that as mixed costs because there's a fixed cost component and a variable component, right? So we see as the number of rooms increases, fixed cost stays the same, but the total mixture of the costs increases. Okay, here's another type of fixed cost, a step cost. Imagine that your factory is so busy that you have to hire another supervisor. Now we know that supervisor salaries are fixed, right? Because they stay the same regardless of production. But now you have to hire another supervisor. So you went from having the fixed cost of one supervisor and then it steps up to a fixed cost of 2 supervisors. So when you see costs go up in that fashion, where they like jump up at certain points, but they stay fixed, that's called a step cost. So graphical depiction of that. So 1 supervisor, here's with 2 supervisors, 3, 4, etc. Okay. All right, now we'll talk about the difference between product costs and period costs. This was covered in financial accounting, so it might seem familiar. Your product costs have to do with the production of your product, right? So, or acquisition. If you're a merchandiser and you're buying finished goods, that's also considered a product cost. It mentions here that inventory is an asset until you sell it. Does anybody know, once you sell your product, it's no longer an asset, what does it become? Yes, expense. What do we call that expense? Once you've sold a good. Cost of goods sold, okay? So your inventory, all the way from when it's raw materials to work in process to finished good, the cost of that inventory is considered an asset. It's only when we sell the inventory that it becomes an expense, which is called cost of goods sold. Now, period costs are not associated with production. They would be things like sales-related expenses, administrative expenses that have nothing to do with production. They have to do with sales and administration. And so the way those work is whatever period the expense occurred in, that's when we count that expense. So for example, the salaries for your salespeople in March, you count those expenses in March. And the salary for the CEO in April, you count that expense in April, right? And that's why they're called period costs. Unlike your inventory, which it doesn't matter when it was made, what matters with the inventory is when it's sold, that it becomes an expense, right? That's why we separate these. Product costs are everything to do with production. They all feed into the cost of goods sold. And period costs are everything else. Okay, any question on the difference, product versus period? All of the company's costs fall into one of these two categories. But we've got other ways to categorize costs as well, which we're not ready to get to yet. I jumped ahead.
Product operations is
Product. Well, operations is a term that can include both production and sales. So really that can all be, yeah, operations is a tricky word. So it's easier just to think of product versus period. Now, what we see here is what I was just mentioning. Once you have a finished good, that means your product is ready to be sold. It is an asset. The cost here is an asset, but we see this asset being credited because it's going away. And it's going away because the product was sold and it's now an expense. And if you remember deal from financial accounting, we debit expenses when they go up, right? So here we have inventory, an asset being credited because it's going away. We have cost of goods sold, an expense being debited because it's going up. If assets going down, then expense going up. Similar to, let's say the company has purchased some insurance, typically pay for insurance before the period that it is good for, right? Usually insurance policies are for a year and you pay up front. At least companies do. And so if you have prepaid for insurance, as time goes by and that insurance policy gets used up, that asset goes away. So we have to credit the asset and it becomes an expense. We debit an expense when it goes up. Same thing with supplies, right? You might remember supplies are assets, but then when you use them, you debit supplies expense. All right? Any questions on that? Okay, here were the other costs I was thinking about. When we're talking about manufacturing costs, they can be divided into these two categories: prime versus conversion. Now, do you remember I told you that manufacturing has three components? You've got your direct materials, your direct labor, and your manufacturing overhead, right? All manufacturing costs fit into those three categories: direct materials, direct labor, and manufacturing overhead. So we can further categorize our production costs by prime costs, which include only the direct material and the direct labor, without the manufacturing overhead. And conversion costs, those include direct labor and manufacturing overhead without the direct materials. So for example, let's say a manager wanted to know what were the production costs, not counting the overhead. They would ask you for the prime costs, and you would know that's just the direct materials and direct labor. And if they didn't want to know the material cost and only wanted to know what is the cost of converting those materials into overhead, into a finished product, that would be labor and overhead costs, right? Because that's what it takes to convert that material into a product. You need to add labor and you need to add your overhead costs. So these are important ways to classify your production costs. Now, you would never add your prime costs to your conversion costs. Who can tell me why that would be a mistake? Huh? Right, because direct labor is in both categories. If you added them together, you would be doubling your direct labor costs, right? And that's going to throw off your numbers. Okay, I think you know the answer to this. Why do we say direct materials and direct labor? What is the significance of the word direct? Exactly. When there are material costs that we can associate with making the product, there's a direct cost. An example would be, go back to the bakery, how much flour went into this loaf of bread? We can count that. Now, let's say that loaf of bread was going to have some seeds sprinkled on top of it. That's a little harder to count, right? Seeds are small, they're kind of hard to measure. So instead of trying to track exactly the cost of seeds that went into each loaf of bread, we might just say, you know what, we're just going to call that an indirect material cost. Or let's say we had some bread that got burnt or fell on the floor, and so we just threw it out. That did not go into a finished product. So that could also be just considered an indirect material cost. So direct materials can directly be linked to a particular product, whereas the indirect materials are any other material costs that did not, go into the final product or couldn't be measured. Same thing with labor. If you have workers going to a training program, they're not making the product during that time. So any labor costs associated with training fall into indirect labor. If the workers have to take time to maintain the machines, again, they're not producing. So it's still a cost related to production, but it would fall into indirect labor. Okay? Direct can be directly traced into the product. All right. Any questions on prime or conversion costs or manufacturing costs in general? All right. Uncheck. Looks like we're doing okay. 5 more minutes. All right. Well, this is a good exercise to end our lecture on for today. So we've learned some different terms here that we can use for our costs. We know fixed versus variable. We know that there are mixed costs, and some fixed costs are step costs, right? We also know that product costs, well, actually, we know there are period costs and there are product costs. And the product costs have 3 components: direct material, direct labor, and overhead. And then we also know we can divide our product costs into prime, which is direct material and direct labor, and conversion, which is direct labor and manufacturing overhead, right? We know all that. So let's just walk through some examples to help it sink in. The rent on a production facility, so the rent on a factory, would be a fixed cost, right? Because it would stay the same every month. Over here, we see it's overhead. Does that make sense? Rent would be an overhead cost. It's not material, not labor. So anything related to production that is not direct material and is not direct labor falls into manufacturing overhead. Okay? All production costs have to go into one of those 3 categories. And because it's overhead, it's not a prime cost, but it is part of our conversion costs. Right? Because conversion was direct labor and manufacturing overhead. Okay, plant supervisor salary. Plant means what? What's a plant?
Take it back.
A factory. Okay, so the factory supervisor salary, it's fixed because it's a salary, stays the same regardless of production. It's overhead. Why is it overhead and not direct labor? Because it's management. So the managers are not making the product typically, right? They're overseeing. So that is indirect labor. And so it falls into overhead. And because it's overhead, again, it's a conversion cost. Okay, then raw materials. It says those are variable. Why are those variable? What's that? Yeah, the total cost of materials will go up the more we produce, right? That makes it variable. And it's direct materials, right? And direct materials are part of the prime cost. Okay, then we have administrative salaries. So these would be people, let me make sure, yeah, okay. These would be people that are not involved in production and have some sort of administrative role. You could have somebody that does administrative work in the factory and then it would be part of production. So these are people not associated with production at all. So maybe it's like a human resources representative or something. Because it's a salary, it's fixed. And because it's not related to production, it's a period cost. Right? Commissioned sales staff. Okay? What does it mean to be commissioned in terms of your compensation? Yeah, you get paid by how much you sell. Right? So it could be variable, it could be mixed. If it's mixed, that means they get a salary plus their commission. Or if it's completely variable, if they don't sell anything, they don't get any payment, right? There are some sales positions like that. And because it's sales and not production, it is a period cost. Okay, the delivery truck. it says here that's a mixed cost. Why would that be? What would make the delivery truck a mixed cost?
The extra miles.
Okay, so there'd be a fixed cost for either renting the truck or payments on the truck. There'd be a variable cost depending on gas, maintenance, which is influenced by how many miles you drive. And because it's not for production, it's for delivery of the product, it falls under period cost. Okay, delivery is not part of production. Okay, I'll go through these last ones really quickly. Advertising is generally a fixed cost because it's not tied to how much you produce. Actually, the other way, your production follows how much you advertise typically, and it would be a period cost. Utilities for the factory are, like I said, utilities are often mixed costs where you have a fixed amount plus, depending on how much you use it, a variable portion. That falls into overhead, which makes it conversion. And income tax is variable, but there are also steps. Well, with corporate income taxes today, they've simplified it. But with income taxes in general, the more you make, the higher interest rate you pay. And that would be a period cost. Okay? So let's go ahead and take our break. See you in 10 minutes.
Okay.